In the first quarter of 2026, two private trading firms generated $22.5 billion in revenue. This single quarter haul exceeded the entire trading divisions of JP Morgan and Goldman Sachs combined. Hudson River Trading recorded $6.4 billion in Q1 revenue, translating directly to $4.2 billion in profit. Jane Street's results were even larger, $16.1 billion in trading revenue, more than doubling their performance from the same period the previous year. These profits were not generated through directional macroeconomic bets on the escalating Iran conflict. The actual engine is an automated, microscopic directional prediction model operating continuously across hundreds of venues. According to Hudson River Trading's own head of AI research, their models achieve an accuracy rate of roughly 50.1%. A 1/10 of a percentage point advantage over a coin flip scales into $22.5 billion when it is mechanically applied across hundreds of millions of daily transactions. This is the Avellaneda-Stoikov equation, the foundational architecture institutional dealers use to calculate optimal spreads and manage inventory risk. When the variance parameter, sigma squared, elevates, the optimal half spread directly widens. But this baseline assumes no directional view, accumulating toxic inventory as prices drift. In 2020, the Cartea-Wang model solved this by injecting a predictive alpha signal directly into the risk mathematics. By predicting immediate price direction, the algorithm automatically adjusts the reservation price microseconds before adverse orders arrive. This keeps inventory neutral, continuously capturing the widened spread. We can see this model operating in the real world by examining a documented empirical footprint. Specifically, we can look at Jane Street's activity in India's Bank Nifty options expiry on January 17, 2024. Between 9:15 and 11:46 a.m., Jane Street purchased 4,370 crore rupees in Bank Nifty stocks and futures and sold 32,115 crore in options. SEBI deemed the futures leg the active alpha signal. After noon, they unwound both positions, netting 673 crore rupees. The public only knows about this sequence because Jane Street inadvertently exposed the strategy during a Manhattan civil lawsuit, immediately drawing Indian regulators' attention. The Securities and Exchange Board of India responded with a 4,843 crore rupee impounding order against the firm for alleged market manipulation. This regulatory order confirms the intraday translation of quantitative alpha into measurable and scalable market impact. We can track a similar empirical footprint in U.S. equity markets for Hudson River Trading. The U.S. Securities and Exchange Commission mandates Rule 605 disclosures, which act as a public ledger of wholesale execution quality. This ledger tracks the execution quality, or EQ ratio. A score closer to 0 indicates the firm offers superior pricing without suffering adverse selection. Data from August 2025 provides a clear comparative baseline across the major market majors. This matrix shows Citadel Securities establishing a baseline EQ ratio of 0.515. Hudson River Trading posted a peer-leaving EQ ratio of 0.315. That score confirms HRT possesses predictive confidence to quote aggressively, filling retail orders without the market immediately moving against them. A structural 0.2 of a point gap in execution quality is the mathematically mandated public signature of a compounding predictive edge. These predictive models are highly effective, but geopolitical events do not generate billions for market makers through single price spikes. The actual catalyst for the Q1 profits was the de facto closure of the Strait of Hormuz in early 2026. This created a cross-asset structural dislocation, causing global Brent crude to entirely decouple from domestic U.S. WTI crude. The Brent WTI spread jumped from $4 to a sustained $11 baseline. Crude oil's peak of $126 was irrelevant. The true multiplier was duration. 6 continuous weeks of elevated variance forced institutional hedgers to repeatedly re-enter the market. When an elevated optimal half spread is sustained for weeks across millions of sequential quotes, the sheer volume yields a $22.5 billion return. This record-breaking quarter is a conditional anomaly, specific to a highly exact volatility environment. The macro invalidation signals are observable. If sustained fixed prints drop below 15, or the Brent WTI spread compresses towards $3, the structural opportunity vanishes. But there is a third internal threat: algorithmic convergence. As rival firms train competing neural networks on the exact same datasets, the predictive edge decays. Over time, Hudson River Trading's execution advantage will inevitably compress back towards its peers. Furthermore, expanding into new geographical markets carries severe extraterritorial regulatory risks, as evidenced by SEBI expanding its manipulation probe beyond Bank Nifty into Sensex options. While predictive accuracy remains a primary revenue driver, model convergence and cross-border regulatory scrutiny establish a definitive ceiling on the scale of the algorithmic harvest.